And welcome to Investment 360. In the hot seat this evening, Neville Chester, Portfolio Manager from Coronation Fund Managers, and he's joining us from Cape Town. Hi, Neville.
Hi, Dave. How are you?
Good. And Viv is still with us, just so that you know. Looking at your allocation exposure, I thought we'd kick off seeing we were talking about Sasol. And you've got an 8.7% oil and gas exposure. You're very heavy on equities. Real estate 4.2%, cash less than 1%, equities obviously 95%. So let's kick off with your assessment of Sasol and how that fits into your strategy.
Yeah. Look, I mean, Sasol came out with a reasonable set of results. They had already given the market an update in terms of trading. And the key result, I think the metric that we're looking at is around production. I guess, if you take a negative from the results, it's about the fact that the production from the Synfuel side is still not up to scratch, something that we'd look for in the second half to come through quite strongly. On the plus side, if you look at the results from Oryx, the GTL coming through with very good production levels, Aria, the polymers operation coming through quite well. So mixed bag overall, I think, a reasonable set of results with the bonus of quite a nice dividend payout as well.
Viv.
Hi, Neville. It's Will Governdy here. Just looking at your portfolio holdings, I noticed that you have Standard Bank as your number one holding. What made you choose Standard Bank over, for instance, First Rand or ABSA for that case?
Yeah. Look, we've got a fairly heavy weighting overall in banks in the portfolio. It's about 15% in total. The biggest holding is Standard Bank. Really what attracts us to Standard Bank, or has over the last little while, has been, the market, I think, has gotten quite disappointed with their strategy. They've had to pull back from a lot of the international markets that they were expanding to pre the financial crisis, given just the change in global banking. And as a result, Standard's certainly traded well below the kind of multiples it used to trade at before, despite the fact we think out of all the banks, it's probably got the most promising long-term growth story. We at Coronation, we tend to focus on long-term unlock where the market's missing something in the short term. And we just think if you look at the growth, their earnings out of Africa grew 38% in this latest set of results. And we think that there's a lot more mileage there. So while the other banks are arguably confined to SA and limited to growth in South Africa, Standard Bank really does offer you phenomenal growth. And I think if you've just seen the growth coming out of Africa in a lot of regions, there's vast untapped markets which they're well best placed out of all the banks to get access to.
Neville, there was a time when Standard Bank was really the bluest of blue chips, not just in its branding, and then it went through a tough time. I think it's the only bank that really twice took heavy retrenchment measures, and I remember Jacko Marie saying, it's terrible, there's blood on the floor, and then he did it again. He did it in the good times, and then he did it again in the bad times. Does that mean it's now lean and hungry and recalibrated for growth?
Yeah, I think so. I mean, the second round of retrenchments really was led by their need to downsize the international business. And, to be fair, I think, what happened in 2008 has changed the global banking stage around the world. You've seen all banks, start to focus on core markets where they can be number one and number two. And so, they've definitely cut their cost base mainly in the international side, less so on the domestic side. But that's what you've seen. I think a hallmark out of all the bank results has been a strong focus on costs, and that's what you've got to do. Like any private sector business, when times are tough, when the top line is under pressure, you have to manage the line you can manage, and that's costs.
Hi, Neville, Viv again. Let's go through MTN. I've seen it's recovered quite strongly in the last week or so. It's come back quite nicely from being in the low 130s to 140 again. Is the Iran situation, do you think that's going to be a major hangover for the stock going forward? And what do you think is happening in Nigeria? I mean, there have been threats by some terrorist organizations to target some South African companies due to South Africa's interactions with certain factions in Nigeria, etc. There's a lot of money to be made in MTN, no doubt, but there's also a lot of international risk. And how would you factor that into your portfolio allocation?
Look, the key thing that we like about MTN is the fact it is geographically diversified. So as opposed to the likes of a Vodacom, for example, which is primarily exposed to a single market, MTN is exposed to, I think it's about 13 different markets between Africa and the Middle East. And that does give you a nice spread of risks. Clearly, Nigeria is their biggest market. And the reason why it's so profitable is because it is a market which does have risks. It's a difficult market to do business in. Obviously, infrastructure is still a constraining factor. and there are the political issues that you mentioned recently. We think that they still run an extremely good operation there. In Nigeria, they can still get their cash out of the country when they want to. It's a very good dividend-paying, cash-paying market. And what we like about it is, given the challenges still there's still huge scope for growth. If you look at the penetration of mobile phones in South Africa and you compare it to Nigeria, there's still massive room for growth. And with that comes some element of risk. As a prudent or conservative fund manager, you just need to increase your discount to make sure that you're using the appropriate discount when you value those cash streams.
Just getting back to the banks, you've got Standard Bank, it's 9.9% of the fund. The other one is Nedbank. Any particular reason? That's with 5.3%.
Yeah, look, Nedbank's been a fantastic recovery story. If you look at how well that stock's done over the last few years, really considering where it was, 7-8 years ago, first under Tom and then second under Mike Brown, they've really come back very strongly. What's nice about Nedbank is that it still is, the smallest bank in the South African context. So as I referred to before, the other banks, because they don't have as big an African growth strategy, are confined to the growth they can drive out of SA. Given Nedbank's relative size, it's quite small, particularly in the retail space. It's potentially got the most room to grow. And we've seen, Ingrid Johnson, who's taken over on the business and retail banking, do a phenomenal job in terms of starting to grow core customers, increasing the non-interest revenue. So that's really the investment case behind Nedbank.
I've also noticed that it's Viv again, by the way. I've also noticed that you've got Anglo-American significantly overweight versus BHP Billiton. What's the reasoning behind that?
Yeah. Look, when we look at diversified miners, and we do think that space is relatively attractive at the moment. And Anglo's, we think, is undervalued compared to its peers in the market. It's attracted a bit of an SA-specific type of discount. We think unfairly so. And we have seen the stock re-rate certainly the last few months, I think, as the noise around nationalisation has started to dissipate and people are starting to take a bit more of a rational approach to extracting value from the resource sector. What we think Anglo's has been doing quite well is coming through with project delivery. It's a number of key projects recently completed in the iron ore space in Kumba, in nickel and in copper in South America. And these are big projects, big assets which they brought on time, on budget. And really the last big outstanding one is their big iron ore operation based in Brazil. So we think that the market's probably not valuing those assets appropriately. We think that there's a lot of value that the market doesn't give them recognition for outside of the listed assets of Amplats and Kumba. When we put those on what we think are the appropriate ratings, we still think there's good upside in Anglo's.
And so you have, obviously, one of the reasons that Anglo has outperformed in recent times was because of those rumours around Glencore. Do you put any weight into that? Is that forming any part of your investment decision making?
No, not at all. We don't invest based on catalysts or views around M&A activity. But yeah, if we've identified something as being undervalued, clearly other buyers of assets might have seen that. I think, Glencore Xstrata are going to be quite busy for some time putting their own deal together. And then of the size that they'll be then, I think certainly competition commissions around the world would probably have quite a bit more to say if they were to try something with Anglo. So, certainly in the current structure, I think it's fairly unlikely to take place. I
think I'm right in saying, Neville, that your top 10 holdings are all international, or not international companies, but South African companies, most of them with an international reach. Any purely South African companies that you think you might be looking at? And I'm thinking of a Massmart, for example, in the light of the Walmart Massmart. It's dragged on, but it seems now to be reaching some resolution.
Look, it's reached some resolution, but this is something that the market's been well aware of and priced into the Massmart share price for some time. So if you look at the kind of ratings or the multiples that Massmart trades on, we think it's pricing for a fairly successful rollout of Walmart's strategy in South Africa and Africa. So you're certainly for the top 20 fund, we're not considering it at the moment. Domestic shares that look interesting, as you mentioned, Nedbank obviously is in the top 10. We do have quite a big weighting there. Within the Bidvest, again, you can argue it does have an international arm to it. We think the company's certainly got some good growth ahead of it out of the SA market. But by and large, we have actually favoured specifically SA-listed businesses which have growth outside of SA, because we think that if you look at the market ratings on most South African stocks, there's been a lot of interest from emerging market funds globally. We think it's pushed the ratings up quite high, and we still expect SA to be a fairly low growth market, whereas some of these companies have exposure to markets with much higher growth potential.
One other company which has exposure to Africa and perhaps surprised people in terms of the South African retail market is Shoprite Checkers. Maybe something that a few years ago a lot of people wished they'd bought.
No, absolutely, and it is a stock that we did own. Remember, certainly when management were trying to do the buyout, we were quite vocal in voting against that. It's a classic case of another good stock which has executed unbelievably well, delivered fantastic results, but accordingly priced for a very good outcome, and not priced for any amount of disappointment. But clearly, very much in the pound seats, driving very good strategy both in SA and in Africa.
One more point from Viv.
Just one final thing. I mean, obviously you have a longer-term outlook, and so many of these stocks are value stocks. But in terms of your, say, medium-term outlook, what is Coronation's view about the market in general? What's your take at the moment? Do you want to be more defensive, more aggressive? Do you think there's going to be a longer bull market run that we're going to be experiencing for the next, say, couple of years or so?
Yeah, look, I mean, equity markets globally, I think the key hallmark you're going to see for the next few years is just volatility. It's not a great answer, I know, but it's a reality. The global crisis by no means finished. We've seen a bit of a relief rally for the last 2 months, I think, as the whole Greek situation has been resolved. But there's still huge amounts of debt sitting out there, particularly in sovereigns. World growth is still fairly anemic. And I think you're going to see good headlines, you're going to see bad headlines. And overall, I think you're going to continue to see a lot of volatility. What is to some extent helping prop up asset prices is effectively the free money, the fact that interest rates are incredibly low. I mean, they're still at all-time lows in South Africa, but obviously at significant low levels in the US, Europe, and as a result, that's forcing people to look at other assets. And when you look at equities still on 4 or 5% dividend yields against sitting with cash earning nothing, that still is very much an underpin and is going to continue to drive equity prices. But that said, interest rates aren't going to stay at zero forever, and at some point in time one needs to start factoring in a return to normal levels of interest rates. And that's why I think just look forward to a lot of volatility in equity markets.